Hi, I'm Steve Brice, Standard Chartered's Global Chief Investment Officer. August marked another month of gains, with most equity markets and other risky assets posting strong returns. This optimism mirrors the positive signals from Fed Chair Powell, who indicated a likely resumption of Fed rate cuts starting in September, after a 9-month pause. These anticipated rate cuts, coupled with strong AI-driven corporate earnings, global fiscal easing, and easing trade tensions, are expected to support global risk assets over the next 6 to 12 months. However, inflation remains well above the Fed's 2% target and is likely to rise further in the short term. Hence, President Trump's latest challenge to Fed's independence requires careful monitoring to see if this could unsettle investors. Efforts to appoint members to the Fed's decision-making committee who are inclined to make substantial rate cuts may lead to heightened inflation expectations, disrupt bond markets, and erode confidence in the dollar, as well as boosting gold prices. Against this backdrop, our Signature CIO strategies have delivered strong returns year to date, benefiting from the rally in risk assets. Maintaining diversification and discipline in investing continues to be crucial in building a solid foundation. So how are we positioned today? We remain overweight and bullish on global equities over a 6 to 12 month time horizon. However, the remarkable strength in major equity markets may have lowered investors' guard when it comes to US trade policy and inflation risks, making us vigilant about short-term volatility. We are tilted towards the more affordably priced Asia ex-Japan equity markets within a diversified equity allocation. Within bonds, we maintain an overweight view on emerging market local currency government bonds as an attractive source of diversified returns and yield. At the same time, we continue to monitor 3 potential sources of risk that could hurt the ongoing rally. First is seasonality, with average monthly returns in September and October being amongst the weakest in the calendar year. Second is US policy, where the risks have shifted from trade policy to inflation and monetary policy. And finally, investor positioning among systematic, trend-following funds, which remain overbought and could amplify any short-term volatility. However, we expect any pullback to be relatively limited in duration and magnitude. Therefore, we continue to see a supportive backdrop for well-diversified portfolios over the coming 6 to 12 months. Indeed, we advocate a strategy of adding to diversified allocations if and when markets go on sale. That's all from me today. Thank you for joining me for this Signature CIO strategy update. I'll be back with another update soon. See you then.